Hey everyone, Sterling here from Day Trading Forex Live. Wanted to do a quick video on understanding chart patterns, again from the bank's perspective. 10% of the banks control 50% of the volume, or well over 50% of the volume, and therefore understanding how the banks view the markets, why chart patterns are or should be important to the retail trader, and what's actually happening to the orders in and around these chart patterns. If we understand that, we understand what the banks are doing. If we understand what the banks are doing, again, because of the sheer volume they move, you understand the next direction of the market, which is what we're all after. So in this example here, we're looking at a symmetrical triangle, and really in this symmetrical triangle, you have two types of retail traders. You have the retail traders that are going to be buying each test of the underside trend line. You have the flip side of that, which is traders believing it's going to break short, selling each test of the upper trend line. And so as these traders get into the market, what is a good little textbook trader going to do? Well, they're going to throw their order, if they're long, below the last low, and as it creates higher lows, they're normally stepping that stop loss up to tighten up the stop loss behind the last low. That's generally a textbook way of trading. Same thing with the highs as it comes down here. Anybody that's short is stepping their stop loss down as it sets a lower high. So as the market pinches and maybe goes from, assuming you're seeing this on a 15-minute chart, as it goes from a 40 pip range or 50 pip range at the start, it works all the way down to a, on average 10-15 pip range. But what happens to the orders? Well, notice, represented by these black lines, you see the orders as the price comes together, so do the orders. Now, this is a bank trader's dream and a retail trader's worst nightmare. The reason for that is because there's the same amount of money, instead of being spread out 40 or 50 points apart, it's now spread out 10 or 15 pips apart. So, for example, if the banks were accumulating a long position through this back and forth consolidation, which formed a symmetrical triangle, how do they accumulate even more of that long position? Again, they can't just simply click buy or sell. That would spike the market. So what do we know about basic market fundamentals? Well, for every buyer there's a seller, and for every seller there's a buyer. That's a basic fact. If you don't have sellers, you can't buy. If you don't have buyers, you can't sell. Therefore, they must create sellers or have sellers in the market if they desire to buy a position, whether euro, pound, whatever it may be. Now, it's the same for you and I. It's just we never have that issue because, again, we drive a much smaller amount of volume in a massive market. Really, we make no dent on it. So in order to induce selling, what do? Well, they start to trigger the market up high. You get people going long. As the market comes back, it stops anybody out that was buying that initial breakout. So what happens as they get stopped out? Well, they're selling it back. They're stopping out. Therefore, they have to sell their position back. Additionally, anybody that was long through this area, if they've stepped their stop up, they're getting stopped out. And what's the other type of trader? Well, you have the type of trader who says, okay, that first move up was false, I'm taking the second break down. As those traders enter the market, again, that's another type of seller. Well, who's buying it from them? The manipulation you see around these chart patterns, you could think it's coincidence until you go back and you see these chart patterns, you see it over and over, and you see the manipulation in and around these levels. Let's take a look at some live charts and get a little better example of this, understand where the orders were, why smart money pushed it into those orders so they could induce either selling to buy into the selling pressure or induce buying to sell into the buying pressure. So here's a great example. This is a Euro daily chart. I'm sure you guys have all seen this. You can go back and look at your Euro chart. Symmetrical triangle formed, and what happened here? Well, the market started to break up. What does that do? It induces people to go long. As the market works to the upside, you have more and more traders piling on as this symmetrical triangle is breaking out to the upside. So as it starts to break out to the upside, retail traders start to tag on long. Really, even indicator-based systems, as it starts to roll out to the upside, are going to be triggering along as well. You think about how many types of strategies are going to be triggering along at this point. You're going to have candle pattern strategies after this nice bullish close here, closing above all these other candles. You're going to have chart pattern strategies, breakout strategies. Numerous strategies on the retail side are triggering along. That's exactly the intended purpose. If they want to go short, they have to find buyers. They have to find buyers to sell to those buyers. That's exactly what they do here. This manipulation is very consistent. Same thing here on the Dow. This works in every single market because liquidity is an issue in every single market. Even a market as vast as the Forex market, 50% is 50%. So if you're controlling 50% of the market, it doesn't matter whether it's a $4 trillion a day or a $500 billion a day like equities. 50% is 50%. So because they move such a large basis of the volume as far as a percentage basis, they have to manipulate the market to induce the other side to enter. Same thing here. It sets this low. What type of trader has orders around this low? Well, again, two types of traders. You have the traders looking to sell the breakout of that last low. Additionally, anybody that was long expecting that low to hold is getting stopped out as it breaks through that low, which again they have to sell it back to close that long position. So if you have all those sellers being triggered there, who's buying it from them? No coincidence that smart money pushes the price to that low, triggers all the selling, buys into that selling pressure. That's where the price runs from. If you guys have been around Forex for a long time, a decent time, back in 2007, you'll remember this one here. All the forums were talking about 1.6000 on the euro. It was a big number. Everybody's saying, if it breaks this number, it's going to be running. What do they do before they turn the market? Before they turn it, before one of the largest drops you've seen back in 2007, 2008, they run the price through the last high. This last high over here was about 1.6015, and on this one, if my memory serves me right, they ran it to about 1.6037 or 38. You have to look back on the charts, but they ran it through the last high by about 15 pips. Again, why? What type of trader is above a high? If you're looking at the retail side, all retail traders tend to do the same thing because they're all taught the same retail trading strategies. You have breakout traders who are buying that break. Additionally, anybody that was short expecting this major high to hold, their stop loss is going to be above that last high. This took out the last high by about 15 pips, stopping anybody out that was short expecting that level to hold. So if they get stopped out of the short position, they have to buy it back, and then you have the traders buying on the breakout. And as the market works to the upside, again, traders going long the whole way. What is required if smart money wants to sell? What is required if the people that actually drive this market want to sell? They have to induce those on the retail side to begin to get long. And when I say retail side, I'm not just talking about you and I'm talking about floor traders as well. When we refer to smart money, we're not talking about floor traders. Floor traders very often are trading their own money. They are not, more often than not, pushing. They're pushing their own money through the market. It's not institutional volume that you're looking at. Now, while there is institutional traders that do move money for other clients through the floor, for the general purpose of traders that are on the floor, most of them are retail traders like you and I, in the sense that they're controlling their own destiny. There's a great series on floor traders that just provides some useful information for any trader. It's entertaining. It's called Floored. You can find it on the web. It might be some useful information as well. So again, we're talking about not just you and I, but there's another scope of a retail trading or smaller institutional trading that is getting manipulated by the larger banks as well. That liquidity is a daily fight. These patterns and this manipulation is how we identify what the banks are doing. The manipulation, these are daily charts, but this manipulation is seen day in, day out, and that's essentially what we're doing at Day Trading Forex Live. The pattern of their manipulation is very consistent. They use the retail traders' tools against them, and it's done not to push the retail trader out for an evil purpose, but because they must have this liquidity. They have to have buyers and they want to sell. It's a basic fact. We use that to our advantage. That allows us to track when the banks are entering and exiting positions. Very powerful tool. So I hope you enjoyed the video. Hopefully maybe you learned something. You start to look for these manipulations beyond these major support and resistance points, or manipulation around these chart patterns as they're breaking out. Learn to trade them. It's a very profitable strategy because that's giving you a strong indication that the banks are either entering or exiting a position. If you want to learn more about the bank trading strategy and more about what we do at Day Trading Forex Live, there's a lot of free information on the site. You can go to www.daytradingforexlive.com. There'll be a link below this video, and you can check out all the articles and videos on the site. Hopefully give you a little bit better insight into it. So until next time, guys, happy trading.